Do you know the reasons behind China's economic slowdown? Well, there are multiple reasons for the current state of China's economy. The post-pandemic recovery of its economy is losing pace. The slowdown in the global economy, the ongoing China-US trade war leading to sanctions on Chinese entities and tariffs on imports from China into the US. The pandemic led to many companies globally trying to diversify their manufacturing units in countries other than China. India is trying to leverage the opportunity and become a global manufacturing powerhouse to benefit from the global movement towards China Plus One. So let's get started and see how and why this is happening. Number 1. The trade war and Cold War. In 2018, a trade war between China and US started. They put taxes on each other's products, causing disruption in supply chains worldwide. This trade war became a bigger problem and turned into a Cold War due to the continuing conflict in Europe. The COVID-19 pandemic made things worse, and some companies like Apple moved their manufacturing from China to other Asian countries, including India, following the China Plus One strategy. Number 2. China's economic slowdown. China's economy is slowing down while the US and the world is trying to control runaway inflations. This is leading to a fall in demand globally, which is impacting China's export-focused economy hard. China is currently facing a deflationary economy in contrast to the world, which is facing rampant inflation in products and services. Number 3. Real estate crisis and rising debt burden. The real estate sector, a big contributor in China's economy, suffered a blow with the Evergrande Group crisis in 2021, exposing the excessive leverage in the country. China's overall debt-to-GDP ratio is at a record high of 28.5%, raising concerns about the health of the economy. So before we go ahead, do you know what a debt-to-GDP ratio is? Well, the debt-to-GDP ratio is a measure of country's financial health. It is calculated by dividing the country's total debt by its gross domestic product (GDP). The higher the debt ratio, the more debt a country has relative to its size. For example, if a country has a GDP of $100 billion and a debt of $50 billion, then its debt to GDP ratio would be 50%. This means that the country owes 50 cents for every dollar it produces. With this, I am sure you would have understood the trouble level of China. Well, continuing ahead, fourth point would be the impact of global central banks. Other countries' central banks are taking strict measures to control inflation, which affects the demand for Chinese products and slows down Chinese economy. Number 5 is the planned economic boost. China's government plans to give a boost to demand in the economy by offering help to consumers and businesses. But because of the high debt levels of people, businesses and local governments, it's tough to recover fully. Number 6 would be India's opportunity after China's slowdown. Because of China's problem, many investors are looking at India for investment opportunities. India has a chance to become a major manufacturing hub. China's economy needs a boost, but challenges like the trade war and the global situations are making it hard. On the other hand, India has a chance to attract the foreign investment and become a strong manufacturing hub. And for now, the Chinese authorities are trying to provide a targeted stimulus to various sectors and consumers to boost your economic growth. Well, thank you for watching our video, and as always guys, make sure to hit the like button, and if you found this video helpful, do subscribe to our channel for more such valuable insights into the world of finance. And until next time, happy and wealthy investing.